Okay, welcome to the Airmere Roundtable. Today's the 10th of January, 2024. So welcome everyone. Special guest today, Thomas Byron in Geneva, Switzerland. Thomas has been trading for a long time. He'll tell you about his bio, but he hangs out in the 0DT trading room in the morning, and we're happy to have him. He's always got great insights and a really, really good trader, and I think you'll really enjoy his presentation. And first time here on the roundtable, so welcome, Thomas. Take it away. I'll be here and monitor the chat and stuff, but yeah, it's all yours.
Thank you very much. Thank you. And first of all, I'd like to thank you, Tom, for making this possible and having this organizing and having great community, traders, and I'd like to thank also Tom Henley, Martin, Eric, Dan Harvey, Terry, Schwartzy, and all the rest of, the whole gang, all the people that share time, passion for trading, and it's been great. And to have a community, trade that is most of the time, it's a very lonely kind of activity. It's a great asset to have, and it is really good to share ideas, to exchange info and keep this community together. I'm really glad I joined, and I enjoy every moment.
We're happy to have you.
So let's see whether I pushed the right button here. No, I didn't. Okay. Let's see. Okay, so the disclosure first, as you know, this is for educational purpose only.
You want to read the whole thing, go to the bottom of any of the Airmere web pages.
Exactly. So a little bit about me. I started the journey as an physical energy trading. That means you trade real cargoes and vessels internationally. That is a very demanding task, because there are a lot of things and details that you have to take care of. And over time, after probably something like 20 years, I learned a little bit more about derivatives. As you know, hedging cargoes and hedging commodities, 50% of it is modeling and dealing with structure that have to do with the financial world and derivatives, swaps, options, and so forth. So I work for international, multinational energy companies and investment banks. I learn models they were using, and from there, after about 30 years, I moved into pure derivatives. And to be honest with you, the only real advantage trading commodities if you have a book of physical stuff like that. You don't have really the insight. So much better arena, the financial world, with the stock indexes and all the tools are available. It's a fair game, and you can put it this way: you don't need a huge capital to move around the risk. So I also have an activity, and I founded an advisory service that served wealthy individuals, lazy, I would say, lazy wealthy individuals.
Successful but lazy. Yeah.
Yes, account managers, other advisors, and family offices. And next, so today I would like to present a workshop and tell you a little bit more of what is included, what is the strategy. More than a single trade, this is, I will call a single trade, just a trade that is good to learn, but trading is combining various trades into a strategy. So starting from the building blocks all the way up to, a complete portfolio. So today we'll go through this, and hopefully in a very, within 1 hour, And I will show you some examples of these trades, and then I will answer some of the questions, if any. So the workshop will include 3 live classes. The first will be basically the core concept of the strategy. The second, the rules and guidelines, entry, adjustment, and exit. Make sure you can read. The last one will be the integration with other strategy or other portfolio in case you have it. All this will be recorded, and I encourage to participate live. So if you have any question, it will be interesting to understand the concern, and I think it would suit better, the learning curve. So then after this cycle of 3, or if it's needed more classes is completed, thinking of starting a trade alert. We'll have 3 to 8 trades per week. This will be delivered similarly to the other services in Aeromir through a Slack channel. Trading tools, I will provide you with some Excel spreadsheets customized by me. Basically, this will help you analyzing the trades, and complete with the package, it will be a video to show you how to use these tools in conjunction with Thinkorswim or Interactive Brokers. So what is the strategy? I trade based on statistics and probabilities, and this means that options versus other forms of trades offer the great opportunity to know in a static way what are the odds of the position you take, single or as a portfolio. And as you know, the main bulk model used is the black and short, and I would say Mertens. So most of this strategy will, most of these trades will close the same day. I would say 95% of it. And when they do not close on the same day, it's just because you are in a great position to carry the trade overnight, obviously with some precautions, some hedges. And the fact that there are now daily option expiration offers great opportunities to basically have trades almost every day. But again, with great opportunities, it's a greater risk because over trading is always a concern. And the fact that you can access the market on a daily basis doesn't mean that on a daily basis there would be great opportunities to take. These trades are simple to execute, and you can trade, let's say with a normal account on SPX, I recommend, but there are XSP, there is 1/10. Eventually there are futures, there is SPY, but we will trade the index. That because it's a cash settlement, you don't have assignment, and you have a tax break if you are resident in the States. Most of the trades will be theta positive, and the profit target will be 5 to 20%. So what single strategy will consider? Well, as you know, the front expiry data are now 0, 1, 2, and that's what we would take. And the back will be the following within a week frame, put it this way. All these trades will be based on the study on the actual volatility curve, whether the market is in backwardation, contango, what are the differentials between the various positions, long and short, that you take. And we'll use a combination here. These are great names, but at the end of the day, the building block, it's puts and calls, right? Then obviously you will try to maximize your margin, because basically the philosophy that in trade you need 3 things. You need capital, you need knowledge, and you need time. So these are the three building blocks. Sometimes you have knowledge, but you don't have time or you don't have capital. In that case, you can ask other people to give you capital. But if you don't have time, maybe you want to follow somebody that has that time available and offers to you after you understand the risk you're taking. And he will sort of give you his time for his knowledge and his time for you to try or to test whether this may be a way to improve your trading skills. So the short DTE, as you know, the DTE now has exploded. Now 70% of the volume of the open interest is within the first week. This has radically changed from the past, where basically was the opposite. It was 30% in the first week, and the rest was back in the curve. So, did increase the capital efficiency of the trades you put. But again, disclaimer, it could be also, if the trades are bad, trading more often doesn't mean that you're making more money. It just, you use, but you have the opportunity in a way to hedge yourself, to trade, to take risk on a daily basis. So that leverage again on already quite high level, leverage level on the options market, in having the opportunity to get in the same day, taking out of the equation the overnight risk, will definitely increase the performance if the trades are understood and are hedge, put, hedge, and exit in a good way. So, obviously risk management is essential if you want to have consistent income generation. That's the key. I mean, if you go in with all the capital you have no more time and no more money to defend the position in case you have to. So that could be very dangerous. That is gambling. It's not trading. So I will never stress enough the danger of using all the capital in your power and sitting a margin call and being forced by your broker to close the position at the worst possible time. So by trading a short DTE, you also have reduced sensitivity to big swings in the market because you are in control of your risk. When the market is closed, that's where the real danger is, because you have no control on what's going on. You can add any hedges in case you have to. You cannot close a position. You just sit down and wait for the next open, hoping that something will come and help you and rescue. And sometimes on the opposite, if you want to sleep with a big profit, most of the time, if you go overnight without the proper tools in place, you will find out that the profit when the market opens is not there anymore. So this is just one of the various strategy, but many people from the zero DT daily trading alert room are aware of this, that they put a lot of double calendar. The double calendar is basically a couple of calendars, obviously, like the name implies. At different, normally they are puts and calls at different strikes. The double calendar, it may look expensive, but it's a good time decade profile and gives you more flexibility in case you need to adjust, because one of the two calendars will probably go in the money. So the adjustments and the other will be out of the money. So the adjustment will be easier in a way. So the core here is to capture the volatility premium. It is start, let's say, at 50 delta. That means at the center of the market, and has a lower calendar in general, has a lower capital requirements because you are short something, but the back you're long, and that is your insurance in a way. So the maximum you can lose is the total value paid for the calendar. The double calendar is the same times two. So the double calendar offers also a greater educational value because if you understand a calendar or double calendar, this will basically encompass most of the numbers of the Greeks and the dynamics of an option trading desk, and can offer a good income on a long run or on a short run. The important part is that you need to understand and know the performance of, especially on the calendar, where it's not so obvious because you will be short something and long something else. So when most of the books and most of the people talk about this being long vega or volatility, well, in reality, this is a very wide generalization because you are short something and long something else. So it's the spread that matters because you lose a lot if volatility explode on what you're short, and if the volatility, the basis with the one you're long remains the same or decrease, the calendar will sag. Basically, the profit that looks good now in a dynamic market will disappear and most of the time will evolve in loss. So a good way to understand this is to do a dissection. What do I mean? Well, thinking about a calendar, it's combination of a short straddle and a long straddle. A double calendar is a short strangle in the first expiry, and the second leg, the long leg, it's a long strangle. So if you analyze in any software the two separately, you will understand the dynamics of both. You will understand a little bit better the risk. So, and these are the advantages. So, trading cost, transaction cost, especially if you trade in size, can be a big drag on this kind of position. That's why probably using SPX, that with the leverage and the size of the contract, even with the minimum, offers a good proportion between the risk you take and the commissions you take. This is an example. This was taken 37 minutes after the market opened. The dates, it was the 25th of October last year. And there is a trick here that even though it's a double calendar, TOS named this double diagonal. As you know, diagonal is a little bit different because the strikes are not at the same strike. But in this case, as you can see, on the first where it says double diagonal here, in reality, is a double calendar. So this is your initial position, how it appears in TOS. And this was after about from 37 minutes after, so from, let's say, 10 o'clock. After 1 hour and 43 minutes, that's the result. The market is 42.11 when you exit this position and was basically there 42.12. So all good. There were no adjustments. And this, by the way, are all real trades. and the snapshots are taken from either a book or a simulation taken in real time. So let's talk a little bit about various, sorry, I have Interactive Broker talking to. So this is a breakdown of the theta margin or margin cost. So, and you can see here that we start with the straddle, then we analyze a strangle, then there's double calendar, butterfly, iron condor, and these are all at the expiry. And to take this example, I took and I show you some data based on the same standard deviation of risk. This is not equalized for the capital you use because, as you can see here, these are the margin costs. So meaning that if you put just a one lot, and all this is one lot, all right? If I put one lot of a short straddle, yeah, my theta is $1,000, but look, the max profit, if we finish at the center, is this, right? $2,800 basically. But the profit here is only 2.87% in a perfect scenario. And this will cover you between break-even down, break-even up at the expiry, a $57 move, right? A strangle, 10 wide, will have these numbers. So slightly less, and basically you had the same market move allowance. The double calendar will cost you 2,540 for 625 theta, notional theta, what you see in TOS, right? So as you can see here, if you close exactly at the center of your structure, and this is a 10 wide, you will make 53% with basically the same market move allowance. Then there is a single calendar. A single calendar, it looks even better. But as I mentioned before, has some difficulties in adjusting the trade. But if you manage to close exactly at the center and the volatility remains the same, the one you are long, and you close it when the other one expires, so your profit is going to be 126% return on the 1,110 that you had a risk. Then there is a butterfly. Butterfly looks even better, but now that's the catch. The butterfly will have a perfect center 1,500. Yes, great, but the move here is only $31 left and right. Then there is iron condor. This is also a very good trade, and I recommend iron condors as well. So let's move into what I use to this analysis. These are the orders where in TOS format, right? And this is the visual. This is the straddle, the strangle, double calendar, butterfly. As you can see, you notice the gray area here covers more or less the same space in this chart. And the iron condor. Now, most of the following examples are trades that were either executed on my account or were simulated with real numbers in various zero-DTE trade alerts live sessions. This was one, and I put when it was taken, and I put a snapshot of not everybody that joined today, it's a member of the Zero DTE alert service. If you have time, I highly recommend joining that service that Irometer offers because it's a great deal. It's a great deal of information, lots of fun. And there's a lot to learn. But anyway, these are all either real trades or simulated trades. This is a combo trade using ES Mini. And as you can see, these are the results. By the way, there is a record of all these trades. If you are a member of that mentioned zero DT trading room, they're all recorded there, live, and a snapshot. So this is another trade, the 2nd December 22. It's a double calendar trade. I also put here the snapshot of the fields because, you know, even though I like optimizations of softwares and offers a great deal of information, but real trades taken live with witness, I would say, you know, a trade is good, static in the past, but doesn't account for fear, greed, hedges, you know, motivations, and all the stuff that is, I think, 50% component in real life. That's another trade example. These are special trades in certain situations. And these names just for fun, you know, this I call it, I can remember the volcano, because you see, you know, I like to make jokes about names and how you name trades. As you can see here, the most important part, I think the one you are interested in, it's that give you very good reward for the time you were in. So this is another trade example at the close. It's what I call a butterfly calendar. It's a mix of both. And also taken the 25th November 22. It's just a selection. There were many others, but you know, since you have a live and me too, I didn't want to list hundreds of them. So next. This is a 4 slides, 15 of March 23. This is a starting position. This is a double calendar in my account. This how it evolves during the day. And basically, sorry, this is the final result. But it's pretty good in my book. As I said, these trades are real trades. These are not just simulation of the past. That simulation is good, but can offer curve fitting, you know, the emotions is taken away. And it is good for building confidence if you do it for yourself. But if you want to promote or you want to teach something, fear, greed, you know, patience are part of trading. So by doing optimization, you are relaxed on your chairs and you find the best trades. And I don't think that works. So that's another one. That's what I call a gamma scalp, where you take advantage of various other things. Obviously, this is just a snap of these trades. In the course, I will go through the building blocks of trades like this, and I go more in details. Unfortunately, now there is no time. And this is the final result. It's a 5% profit the same day. So that's another one, 13 January 23. This also at 20, no, whether it's 20 or 30% here. I mean, it's a good trade. That's the bingo trade. It's a calendar combined with a butterfly. That's the initial trade. And left, right, the result, same day. Sorry, this is the result. This is the result the following day. So this was at the end of the day. So the end of the day was 16%. But if you had the guts and the hedge in place, the next day was 47%. As you can see, let me go back. The market was around 60 here. And the next day you are lucky, you are still there. But look how wide this is. Like basically there's no risk. So This is the bad trade with a hedge, right? You start the position like this, you add a strangle in different expiry, and that's the result. It's a 12% trade. This is a very interesting trade. This is during Halloween, I call it the night witch. It was share live. And you see, there was some important data pending in the market, and volatility was very high. We entered this trade here, and the initial trades were like this. So he evolved into this on the left, moving to the one on the right. I call it the night witch because it was Halloween, and also because you will see at the end, this is like a witch. That's why I call it the night witch. The night witch implies that on this, you have to stay overnight, unless you want to take the profit around 3, 4, 5%. But if you have the ability to stay overnight, but warning, on this one, you have to go and use futures, ES-mini. So you go overnight, and it looks like this. Then it morphs into this, and then all the volatility at 2:30 my time, that is 8:30 Eastern time, disappear from the trade, and that's your result, 11%, $3,000 of profit. This is I call it the night witch goes to sleep, right? So obviously this involved, let's go back again. This is the real witch appearing. This involved also being hedging this with ES-mini. Okay, so some of you know Option Omega has been around for a little bit more than a year. It's a great tool for backtesting because of the granularity of tests. It's based on 1 minute. They're great people, engineers, they have the software, and this is just to show you a simulation on a single calendar. As you can see here, it's taken every Monday. It's a 50 delta, right? And these are very realistic performances in line with the performance of the real trades. That's another one. This is a double calendar. It's a 1/7, taken every Monday, right? This is my test rank of the strategies, and I'm very specific testing, and I will tell you later why I'm testing. I'm testing not to find a good strategy, but to find the levels at which you take profit, at what level, basically what is the performance of every single strategy that I use vis-a-vis various market situations, various volatility levels, various, I would say, regime of volatility. This is a rank based on the percentage winners, 100%, and I have basically 284 of this, and every day I update everything, and I have a sort of menu that guides me to find if there is any evolution in this strategy. And let me stress it again. These are not strategies that I find using the tool. These are strategies that I use, and the tool is helping me by finding the min-max capability with different simulation of the trade. So I know what is the performance. Let me give you an example. If you have a trade, let's say that on average in the last year, it's gone from -5% to +20%, and remains in that range. Now you know what is the top performance. Now you know if you want to squeeze 5%, at what level of that strategy you are right now. And so you make a decision that is based, given all the rest of your consideration, the capital you use, the other exposure. But let's say that single position, let's say, if you target 2%, you know that 2% is like 20% of what the position can achieve that given day, that given time. And I do every day this kind of analysis. So these are more. and these are more. I didn't put all the 270, but you can understand that it's pretty tedious. So this is my own proprietary analytic tool that I will share with you. And the good thing about this, there has some calculation in the background. These are just 2 snapshots of there are many pages on this, and I will teach you how to use it. But the important part here is your combined portfolio as a weighted bag based on the DTE that you use. That will give you other theta. People call it VOMA. I mean, the relation between bag and theta and capital, and so forth. The correlation among the strategy, and I will give you instructions and the spreadsheet. This is linked to TOS like data. Good advantage of this that you can use as live data also simulations. Meaning in TOS, if you go in TOS and you put I can't remember what's the name, look back, or how do you call it? On demand.
On demand, yeah.
Yeah, if you put on demand, it's a little bit slow, but it will give you the feed for this with the on-demand price. Think that TOS won't give you the graph representation of this, of the numbers, but here you can. I mean, and so you can analyze this and do a bit of research on your own. This is still part of the same spreadsheets. This will give you the TOS numbers, and the second part will be a modeling done by me with numbers following the model. That is not a Heston model. That is one of the model system largely in use, but it's a tweet. Basically, this is tailored for calendars because we'll give you the Vega weighting more realistic and the theta more realistic based on a proper model, not just TOS. Because of what I found out, that people don't like calendars because, yeah, you see a software that doesn't tell you really what the real position is. So basically, you open the position, it looks great, then you get to sleep, hoping that this will transform you in a millionaire. You wake up next day, and there you go, you have a loss. So the 2 things I just said, well, knowing their performance historical, min-max will help you, 1. 2, having a sort of proxy that translate those numbers you see in TOS in real number, and accumulating those numbers will give you the confidence to stay in the trades or abandon the trades or not taking the trade. So these are the 3 most important factors when you deal with options. You need to understand properly the risk you are taking, and the risk, or put it this way, the risk on not taking a risk. The maximum risk in trading is not taking the risk, because you're wasting your time in front of a computer and, without making any money. But at the same time, when you put money at risk, you have to be sure that you put money at risk, not with the broker rosy picture, but with your own numbers, so that you have a sort of frame. You know how much you can squeeze from a strategy or a portfolio. So when you have a 20% and the software will tell you, oh, you can make 50%, and you know that the maximum of your strategy is 15%, well, that's your lucky day. You shut it down immediately, because you don't base your judgment on what the broker is telling you. You base your judgment of what your analysis and your model is telling you. So this is one of my accounts, a real account, because everybody's saying, oh, I'm good, I'm not good, whatever. This is from September to December. This is using Trade Steward. These are real trades on my TOS accounts. No overnight trades, apart from, as I said, 5% of it. And this is the performance. It's about 30% return on capital. I didn't take over the years because, who knows, maybe I've been lucky in the past, they are real trades. They're not just to show, because at the end of the day, people say, well, show me what your real performance is. The important part of this is that you can see that the shape is very similar. Let me go back. the angle of attack is very similar to this. See? And you will notice that also the drawdown are very similar to this, because when I use this software, I don't look for comfort and say, oh, maybe tomorrow I'm going to be rich if I do this and I start today. No, I'm trying to find the optimal levels for this. That's why the two levels, the degree, the angle, I will call it, because the arrow mere angle of attack, yeah, is the same, right? The performance is the same. That tells that you've done your homework right and you put in practice what you learn. So the bad part, the workshop, the cost of this, the workshop, or we said will be $500. After the three, or eventually if it's needed one more workshop will be completed, there will be a trade alert, because I thought, not everybody has the time. Maybe they have the capital, or even with small capital, they can implement all this strategy using a reduced version of this. But if they don't have the time, but they still want to learn, they can learn, and they're having to put it this way, put in practice or in a simulation what they learn is a great deal. So you can probably be better than me, because I'm very conservative with my capital and with the profit I take. But I will give you my own advice, my own studies. And put it, this is the dynamic versions of the workshop. Obviously, these are all trade alerts for simulated educational purposes. It doesn't mean that you're going to put it real or whatever. This is up to you. But if you learn and you're confident, I really encourage you to do so. Also, I encourage you not to take snapshots of the good position I show you and just, with the magnifying lens, go there and check what I did, because I did what I did live based on market conditions, and in the future, market condition may be different. So do not replicate this without investing this amount of money in knowing a little bit better where to enter, where to exit, how to hedge it. Because if you do so, you will regret, because you didn't spend 500, but you may lose much more by just replicating trades without understanding what they get. So
are you going to require the workshop for the trade alerts like Amy does, or can people sign up for the trade alerts when they're available without the workshop?
I think, to be honest with you, I'm not that stringent, but I will highly recommend to do so.
Okay.
But then again, there are other people that just want to, it's your money, So you have to, I feel responsible to tell you do so, but if you just want to have the trade alerts, fine, you can do that. With the trade alerts will come a lot of question and answer. Obviously, it's up to you. I mean, we are all, I assume if you risk money or if you want to learn something, you have to go for the package. But if you risk money and it's entirely up to you, you just want to add the trade alert, fine. With me, it's fine. But I don't recommend to do that, as I said. So.
And Gerhard asked, can we have a copy of the presentation? So if you
Sure.
send me the final version, I'll make it a PDF and make it available.
I will.
And then there was another question, how much capital is required to implement your strategies?
As you notice, there is my recommendation, and the fact that I base all my performances in percentages is important. Because, you may have an account of 1 million, 2 million, 10,000, 20,000. So these are percentages. Bear in mind one thing, that in options, there are two factors here. Well, the broker commission is one, and second, what I call units. So in the modeling, especially for short tenor DTE, a unit means that, talking about SPX, 5 cents is the minimum. So 5 cents out of the money doesn't mean that that is a Black-Scholes model of the risk of that. It's just a unit because it cannot be break down any further, right? So that wasn't a problem before. If you deal with 30 days and you exit 1 week before, you have few units in your book. But nowadays, when you look at units, units are units, meaning cannot be break down. So the delta of a unit is not really a good one, because the Black-Scholes cannot break that down mathematically. That's one problem. So I will recommend to trade this with an account of minimum $20,000 and keep something like 25% of reserve if you exit the same day. That's the minimum I recommend
Well,
using
there's a lot of
SPX.
zero DTE limitations if you're doing SPX. So I would say 25 to avoid the pattern day trader restrictions.
Okay, let's say 25 then. But if you do 25 and after a few bad trades, you're down 5, well, you need to put more capital. So let's say 30. But if you do if you use other tools like XSP, that is 110, there you go. You can use a smaller scale. But remember, there are two values here: the educational value, regardless of what your capital is, and the trade alert. For the trade alert, I will go more in detail during the workshop exactly how much capital you need. In my book, I take roughly for clients I have like minimum 80% reserve, right? For my book, I made more. I take probably 40% reserve. Reserve, I mean, I don't touch the capital, but I will say 25 is really the trading SPX is, as you said, rightly, is the minimum. But then it comes another point that in that case, at the minimum of your capital, you should never, ever go overnight. So forget about a night witch, forget about those kind of trades, right? So because going overnight with no margin, no power is not a good idea. So in that case, 100% of the trades should be closed. And again, and your target, let's say, if I give you the guide and say, well, my target is 5% today, let's say, if you trade a small account, maybe your target should be less than that, right? To avoid, because you have less power to make adjustment or to do hedges, right? So that's about it. But as I said, in my opinion, trading is dynamic. And part of trading is your margins, the use of your capital. The first rule is there are no rules. It depends what the market gives you. You don't forecast what the market is going to be. You react what the market gives you. But the problem is you react with some capital, because if you react with no capital, even your knowledge is very big. There's nothing you can do. Like there's nothing you can do. So I would say that's not much different from some of the other services I've seen on Arrowmere, like AMI and stuff like that. So there are the difference is that this is combination of various strategies. But let's say in a day I give you 3 potential strategy, and your capital doesn't cover all those. Well, it's up to you to pick one. If you have enough capital, you can do 3.
And then Bill asks how many adjustments during the day are typical.
That I will not tell you right now, because as I just said, I don't know. But I will be sure that the volume you put initially has some reserve to be able to exit and edge the trades within the trade performances. So it's not going to be, some days you probably end up with 2% and regrets because the position will make more. But that depends on what the market is doing, the volatility, the study, and the day of the week. The days of the week are different, because if you put the calendar, let's say 1/7, costs you a lot of money. If you put the calendar 0/3, mean Friday, Monday, they cost you less. So these are all things that there is not a rule that covers them all. It's like talking about calendars, time spreads. Different is, butterfly is a butterfly. Your gamma, so your gamma, by the way, is a second derivative of delta. So the acceleration of your gamma in a 30-day butterfly is almost nil. But also your capital is intensive, but your theta is almost none, right? So you will find the right balance, and to find the right balance, it needs to be developed starting from your capital, your time, your commitments, and your goals. If you want to make, I don't know, out of a $30,000 account, 1% a day, it's okay. You may have very few adjustments to do that. If you want to make 20%, then you have to stay longer. You have to foresee adjustments. This is a performance is based, the risk on, risk off, and the capital you use has to be compensated, logical, and you have to have hands on deck. If you manage to stay longer, the reserve will be bigger, because if you stay longer, it means that possibly more adjustments are needed, because the market will move more. There is more time for the market. But this is all statistics. Let's say that, and I want to share something live that wasn't in the presentation. Sorry, no, this is not what I want to share. Okay, let me share this. This every day we use this. This is what the market, it's a great website. This is 0DT. This is 0DT, but I have analysis for 1DT, 2DT, 3DT on my own software. But put it this way, this that you see here, the at the money drawdown, right? So the loss of value, so you gain or theta, the market make a move or whatever you call it, it's $17 at the start of today. Now is 9, right? Great. What is the problem with this? Well, you have to be able to stay at the center of your price all the time. And that is not possible. If you plan to stay at the center of your strike, that is the most profitable position to stay center, right? Well, you need to foresee a lot of adjustments, because unfortunately the market will stay there forever. So the intensity of your capital and your trades, it's a function of the time you are in the market and your goal. So that's essential. And this that I just show you doesn't mean that the market now is always retaken live at the center of the price. So unfortunately, you cannot stay at the center of all the time, right? But you will have to find a position that is manageable enough not to have too many adjustments, and to allow you basically to have a reward for the time you invested and your capital you invested that is logical, that is feasible, and is repeatable. That's why we trade on statistics. Next, it's this is the trade alert things, right? That is in line with the arrow mirror style. And last,
remember, this doesn't start until the workshop's over. So
yeah, exactly. Yep. And then, okay, this is just the final one. Let me. There was something else I wanted to share that is not being included. Okay, it is this. This is a 50 delta calendar, right? Sorry. One 6. Okay, taken Tuesday. So updated up to the 2nd of January. These are 20 lots, but performance doesn't, it's pretty much in line. Obviously, here you don't have, there is a point here where you don't have trades, right? You don't have that trades because the zero DT, the everyday DT is something new. But when you do this, and in case you use this kind of software, do not look, in my opinion, do not look for the perfect strategy using this. And when you do the optimization, be sure that you put a realistic one, like require 2 consecutive hits of profit target and 2 consecutive hits on a stop loss. Include obviously the cost for this thing, right? Fees. And basically this great tool, and I want to promote this, but they give you basically a breakdown of the strategy. This will help you immensely to understand, based on the strategy, the performance of the strategy. See, you had some losses here. This was a big loss. What happened here? Oh, boom. That wasn't a good day. But anyway, that's about it. I keep it within 1 hour, as I said.
There are a couple questions, and Bill asked that the alerts and adjustments should be via SMS, and we can do that. I can show you how to set that up on the admin or the expert side of things, where you set a trade alert. It'll go out via email, text, and Slack. So that's probably something we can do. And then the workshop will be live, and I think it's going to be on weekends, on Saturdays, right?
Yeah. Yes. Also,
And
I have a pledge to make. I will not let any of the people joining the classes, the workshop, without a question answer, put it this way. I will not guarantee that, you could make money, but because I'm not able to do that, unfortunately. But I will tell you that I'll do whatever in my power to answer all the questions you have. Not only there, you will send me emails or whatever, and I will take time to answer. So,
and there are a couple more questions. Ken asked, are you able to share what the average max risk is per trade?
I will share during, well, I just did. Let me go back. Max, sorry, that's not the right one. This trade alone is 50 calendar from November 2020 to that's the max throwdown. If you go down here, okay, there's the average loser, the average winner. You will notice that most of the trades are 75%. Why? Because it's basically a little bit more than a standard deviation around the money. So you want to keep this on the money. But these are not hedged. They're hedged by profit taking and are hedged by stop loss. Bear in mind that these are raw, meaning all this is without the hedges. That's why you analyze the single one to understand how far and when it needs to be hedged or when you need to put another position. But to answer your question, this particular trade, it's about 8% drawdown. Now, if you filter with the losers, right? This day was the biggest losers, was $4,000, right? The 3rd of October. No, sorry. There was this one, big one here. But bear in mind, this probably were days I'm not sure about this. There were days where there was a big announcement, the Fed or something else. So this is a raw data, meaning that maybe that day you wouldn't in the market, right? Take the trade. So you can avoid some of this. But let's say you trade every day, right? This is your maximum drawdown. I hope that answered the question. It was a great question, but
And then let's see. Abraham asked what the average time in a trade is typically.
another great question. I would say is about 3 hours.
And I know the answer to this one. He says, "Do you trade NDX?" I think
NDX, I do not trade NDX.
yep.